Hello, here is Nedu, your forex coach. In today's video, we're going to be looking at how you can deploy a very simple forex trading strategy to grow an account of $100 to $1,000 just in 3 months. And I'd like you to pay very close attention to this. If you're coming here for the first time, we'd like to say welcome to our channel. And if you've been here, you're one of our subscribers, welcome you back. All right, let's just go right into this very lovely strategy. I'm sure you're going to like this. You're going to like this. Okay, let's look at it right away. Okay, use this strategy to grow your account from $100 to $1,000 in 3 months. And this works. Guys, look at this. Okay, so the first thing that you're going to do is to go to your price charts. This time around, the 4-hour time frame and the daily time frame to locate turning points. You know, turning points. These are price zones where price usually will bounce off. Okay, over a period of time. You know, these are the support and resistance zones. Some people call it the demand and supply zones, or whatever it is. Right on your charts, just mark those areas. You mark those areas, whether they are support or they are resistance on higher time frame, 4 hours and daily time frame, most preferably. Right. So once you've done these, and these zones can be identified as any of the following. You know, it can be your normal regular support and resistance. Okay, you see on horizontal, basis. They can be on trend lines. In this case, you are looking for a trending market. You can find this happen in a trending market. You can find this happen in a market that is ranging between supply and resistance zones. So we can see this in the trending markets. We can also see these turning points, around pivot points, the pivot key levels. You can see this there. You can identify those on the charts. Also, your yesterday lows and also yesterday highs, your psychological levels, those magic numbers, the zeros, the halves, and the quarters. All right, maybe 1.00 price, 1.10, 1.25, 1.50, 1.75, and then 2.0, all those kind of price numbers. You can also mark them on your charts, all right, and see how price responds and reacts to those levels. Those are turning points. Here, the major thing is I want to identify possible turning points, areas where price will approach and then reverse or break through it, right? And the best areas, we're trying to make it very valid by going to higher time frames, okay, and then introduce some other things that can help you identify very valid support and resistance. And once you have done this, that's the first step. Once you have identified this support and resistance zone, you're a step closer to achieving the results. Okay, we have the psychological levels, we have some reversal zones on moving averages, particularly the EMA, and also on Bollinger Bands. Anywhere price has a likelihood of returning. You see in the Bollinger Bands, have the upper band and the lower band, and the strategy around the Bollinger Band is that when price touches the upper band, it will usually come down. Okay, it drops, and when it touches the lower band, it goes up. So those upper band and lower band of the Bollinger Band, they also act as support and resistance. In moving averages, can set 2 moving averages, maybe 21 EMA and 50 EMA. The space between the 21 EMA and 50 EMA, they serve also as retracement zones, areas when price will approach and then it bounces off. Okay. Now, the next step, once you have identified these, the next thing you do on your chart is to set up the stochastic indicator. The stochastic indicator is probably one of the best indicators that enable you to identify these reversal zones, these turning points, all right, because it's calibrated in such a way that the area, the value between 80 and and 100, okay, acts as the level where the market has been overbought, okay, and from 0 to 20 represents, the values where the price had been oversold. Of course, in forex, when price is overbought, it begins to sell, and when it is oversold, it begins to buy. All right. So with the stochastics, adding stochastics to validate those your identified areas of, identified possible areas of turning points of support and resistance. So bringing in the stochastics will validate those ones. So any of those areas that is not validated by, that you identified as not validated by the stochastics, you can just, eliminate those ones and leave the others, because you want to get very valid turning points. You want to identify very valid turning points. So when you add this stochastics indicator to it, it helps you to become more precise. All right. So that is just the major reason for bringing in the stochastics. Okay. Now, next thing is when price approaches these reversal zones, these turning points, there are two possible outcomes. Okay, two possible outcomes. One of them is the breakout. Price might break that zone. Okay, if the price, if it is the resistance zone, price might get to it and break through it, depending on the momentum and what is driving the market at that point. So it can break it, or it can bounce off at those zones. So there are two scenarios here. We have the bounce off and then the breakout. Both of them will offer, a forex trader, okay, an opportunity to trade the market and then to make profits. Okay, so we'll move to the next slide. Now, look at the two opportunities. We're going to show you some. Now we're bringing in candlesticks. The first thing we did was to identify the turning points in the market on higher time frame. The second thing, to validate those turning points I've identified, making use of stochastics. All right, making use of stochastics. Of course, when the stochastics value is above 80, between 80 and 100, okay, it is overbought, so price may turn down. Okay, so if the stochastic value is between 0 and 20, it will be oversold, so price may likely bounce off and begin to buy at that particular time. So we introduce that to get that, help you validate those points of identified. So the next thing now to do is to look at the valid turning points of identified. We're going to look at the candlesticks formations around those identified value points. And at this time, you are beginning to get ready to take a trade. So you have to move your time frame from the 4 hours, okay, to 1 hour, or you can even go lower to locate some candlesticks price action, pure price action that will validate that point and then give you an opportunity to take a trade. One of them is this one of them. So we're going to be looking at the two scenarios: the bounce off trading opportunities and then the breakout trading opportunities. Now, for the bounce off trading opportunity, in case of the bounce off outcome, okay, at identified and validated, key level, look out for the following candlestick patterns to enable you confirm the bounce off and to take a trade in the direction of the bounce off. All right, one of them is the bullish engulfing pattern, and bullish engulfing pattern is spotted at a support zone. And this support zone should also align with the stochastics at the point when the stochastics is below, the value of stochastics is below 20, all right, is being oversold. Okay, it's been oversold. You identified the support zone, and the stochastics value is between 0 and 20. So it's showing that the market has been fully oversold. So it's getting ready to bounce off. So when you see these candlesticks from there, all right, so this is a confirmation that that turning point is valid. So we begin to take a trade. See, this is the engulfing pattern. You see that the green, the bullish candle fully, this is a bullish engulfing, is fully, engulfed this bear candle. All right, so this scenario here, price has been dropping and approaches this support zone, which is identified turning points, which is confirmed with your stochastics, and these forms, these this whole signal candle engulfing, bullish engulfing pattern has formed. All right, when this has formed, this is a confirmation that the price most likely will not go downward. So this providing us with a trading opportunity right here to enter this trade, allow the bullish candle to finish form. When it finishes form, so giving you this total engulfing pattern, take a trade 5 pips. All right, about 5 pips above the high of this bullish engulfing pattern, the bull candle, 5 pips above. When it closes about 5 pips, from 5 to 10 pips, you can put your the pending order, right? The buy stop pending order. You can put it, set it up there, and then come about 5 pips at below the low of this bull candle and put your stop loss, and then your take profit should be times 2 of this risk, times 2 of the number of pips from your entry to your stop loss. So maybe around this area will be your TP, just times 2. Your risk to reward ratio 1:2 or 1:1.5 is still very, very good. So you don't take so much risk, you don't stay so much in the markets. All right. So with this, you are good to go. Price, you see the bull candle comes and triggers you in, and then price continues to go and hit your take profit. And I would like you to know that whatever information we're bringing here, this is not in any way a sell an investment advice. Okay, this is just for the purpose of education, to bring you more insights on what to add to your trading skill to make you, a better trader. And you can backtest them over a period of time. You can use the strategy, backtest it over a period of time before you can begin to apply it on any live accounts. Okay, let's see another pattern, the candlesticks around that turning point. So this time around, this is the bearish engulfing pattern spotted at a resistance zone. Okay, this is the bearish engulfing. You can see the bear candle, the red candle, fully engulfing the green bullish candle around the resistance zone. Okay, and this resistance zone should have been validated with your stochastics. So at this point, we're expecting the value of the stochastics to be between 80 and 100. Of course, in that zone, the overbought zone, the stochastics can still be there and price will continue to rise. Okay, continue to rise. So all these things you are bringing in to arrive at a high probability, identify a high probability trading opportunity. Most likely, this price is going to drop after this candle has formed on a major turning point on the resistance area, and we have seen the stochastics is reading overbought. All right, so this is a scenario. Price can see the bull candles rising into this area, and before now, this area price would have tested it maybe twice, thrice, and this is top time is coming in, and we are seeing this engulfing, bearish engulfing, pattern showing up. All right. So what you do when the bearish candle, this bearish candle are fully formed, what to do is to come around this area. You can see this candle mean that price move backward. A lot of times price can move backward to the level of about 50% of this bear candle, all right, to this bear candle. So if you enter instant trade at this point, price can move back, maybe discouraging you, seeing your trade now in some negative. So one of the best ways you can trade it is to just come low at the low, about 5 pips at this low, below this low with about 5 pips here. All right, you put your sell stop, and then around this area, about 5 pips above the high, you position your stop. And of course, you identify this setup when you have identified your turning points, okay, and you've seen this there, you can move to your lower time frame 100. The 1 hour time frame can move down there to see this pattern around this, so you can begin to look for opportunities to enter the market. 5 pips above the high should be your stop loss. 5 pips below the low of this candle can be your sell stop price, okay, and then 2 times the risk okay, can be your reward, your take profit. 1 is to 2 is still fine. But of course, that does not mean you should, maybe even if this wants to just get out of the market, that would be a very conservative, trade. If you see the potential that the market can do up to 200 pips, you can just decide to be trading it. Remove the your take profit and then give the price about 50 pips to break or 40 pips to break. You just be trading it 40 pips. When the market has moved to this point, you can take your stop loss to your break even, your entry. It moves, you just be giving it 40 pips, 50 pips, space to break. So this is one scenario that we can find, an opportunity to trade in a bounce off scenario. Okay. Now the next is the railway track. I'm not going to go through all this, but I'll just show you some of them. Railway track is actually a candlestick, 2 equal candlesticks, bear and bull candle, forming around resistance or support area. It's actually a reversal, signal, whether it's forming at a support or a resistance. In this area, we're seeing it form at a resistance area. All right, price moved into it. You see these 2 equal candle. Most times they are all equal, or slightly one is slightly longer than the other. Right, it's just cancellation. So the bulls made a point. The bears said no, they just returned it back to where the bulls started. Where that candle opened, the bears pulled it back, canceling that bullish move. It's actually a signal that the bearish pressure is beginning to mount, and this has happened at an identified turning point. So this can give you also a tradable opportunity. The same way you come in here when this candle has formed, I told you that whenever this happens, price usually will pull back because the sellers may just decide to sell off some of the profits that they made, and you see the market pull back slightly. Before you know it, more sellers will get interested and then drag the price downwards. Then usually after the signal candle, there could be a pullback against your projected direction. So don't be so much moved. Okay. So the reason I always tell you, maybe about 5 to 10 pips below the low of that signal candle, you place a sell stop there, and then 5 to 10 pips above the high, you position your stop loss, and then you take profits 2 times that's your risk. Another candle formation that you can see around those turning points is what we call the morning star. The morning star, is a bullish reversal pattern and can be located at the key support zone, okay, for a bullish bounce of trading opportunity. You see, price moved into that zone. Okay, and the morning star is just a combination of 3 candles. Okay, you see one bear candle, and then you can see a doji or just a spinning top, very small candle in between them, and then you have the bull candle push up. So this one shows bearish pressure fading off, bearish pressure fading off. See this doji here, that's what it means. There's a very strong momentum pulled down, and then this happened, showing that the weakness of the sellers, and then you are seeing the bulls mounting and increased momentum. So this setup is what we refer to as a morning star. So when you find this morning star on a support, because you just look at it on a support zone, you can form in several other places, but when you see it on the support zone, is actually a bull signal indicating price movement in this direction. You can see these 3 candles, 1, 2, 3, and you can see this black candle, which is the bears here, a little push downwards, which actually, because it is small, it's also indicating that the bears trying the volume is reduced. Few sellers are in the market, while the bulls, will take the lead. And immediately after this has happened, you can take an instant trade from here, calculating your risk the same way that we have mentioned. Another candle formation that you can see is the evening star. The evening star is just the opposite of the morning star. All right, in the morning star you have the bear candle, and of course the evening star is a bearish reversal signal forming at a key resistance zone where price is expected to bounce off. Now I told you earlier on that price may approach that area. If it bounces off and give you this pattern, is a signal, is the confirmation that there is a bounce off. okay, there may not be a breakout from that particular key level. Okay, two scenarios: price may just break or price may bounce off. So seeing an evening star at a key resistance zone is actually a confirmation that price most likely will have to bounce off. And of course, you validate this at the same time with your stochastic indicator showing you that the market is already trading in an overbought, condition. Is already overbought. So this forming is a confirmation. What you need to just come 5 pips below this low. These two candles most times are of the same display. Just come here 5 pips below that low and put your sell stop, and above this place, above the Doji there, you can put 5 pips there as your stop loss, and then you enter a sell trade, expecting the market to begin to push downwards. We see another scenario here. In this case, is a dragonfly doji. All right, dragonfly doji is actually a bullish reversal signal. You locate it in a bear market, and market is trending downwards. You can see here price is trending downwards. It hit this support level. Okay, this is the support area, and pushed back, and then did a retest and give you this signal. That's a dragonfly doji. All right, you're going to take a long position somewhere at the close of this, maybe about 5 pips above the close of this bull candle. Okay, above this bull candle. When it finishes, this actually confirms that the market actually has some bounce off. So okay, below here you can put your stop, calculate 1:2, risk reward ratio. Right, so the other one is the gravestone doji, which is the opposite of the dragonfly doji. This time around forming at a key resistance, zone. Okay, this pattern provides bearish bounce off trading opportunity. Wait for a close below the gravestone doji and to enter your bearish. So close below the gravestone doji, and then you enter into a bearish position, and that is it. Here you can see a live chart here. This is that gravestone doji that finished forming. All right, can put maybe 5 to 10 pips below it and set up your sell stop, and you can see market moved all the way down from here around this area. Price moved all the way. Right, 2 times your risk can be your reward, your take profits. Then we'll move to another possible candle formation around this turning point. This time around, we're looking at tweezer. So we have 2 types of tweezer. We have the tweezer top forming at a key resistance area. As it here, price push into resistance zone, a validated resistance zone, which you already have validated using your stochastics indicator, and then price pushes into that place, and you have these 2 similar candle with long wick. Okay, when the candle has a long wick on top of it, it means that the strength of the bias, okay, is reduced. Okay, the strength of the bias is weak. If this long wick forms below at a key support areas, it means that the strength of the sellers is reduced. So you can see it forming. This is a confirmation around a key resistance area. You begin to get ready to take a trade using that same approach. 5 pips below this below the tweezer is can put your sell stop there, expecting the markets to push downwards, expecting it to push downwards, and if he does what it to do, price will move up, return here, come back and push back up, and then before you know it, it has hit your take profits 1:2. Risk reward is advised. So you don't make it too big. Okay, and this can actually be giving you like 20 pips, 40 pips on daily basis, depending on the size of the account. Like we said, with $100 within 3 months, you can grow it consistently if you follow all these validating the setups and then validating your entry, doing this diligence before you enter the market. The conditions for setup must be fulfilled. You need to be patient enough to identify them on your trading instruments. 4 hour, between 4 hours of daily time frame. You can do all this. This is the tweezer bottom. You can see it long wick, two identical candles forming at a support zone with these two long wick. Usually it may not have an upper wick. So, and that actually is an indication of the weakness of this trend, the withdrawal of the sellers in the market, forming at this support area confirms this. And of course, we expect the value of the stochastics at this point to be less than 20, so between 0 and 20, and the crossover of that, the percentage K and the percentage D, legs of the stochastics should give you also an indication that market price will begin to rally. And in this case, this is what we have at this point. 5 pips lower than this place, you can come here to position your stop loss, and then another 5 pips above the high of these tweezers can be your entry, a buy stop entry. Okay, you can see that price actually moved down a little, about half the length of the tweezers. Okay, it's about here. Before it pushed up, it will fill you in when it has moved about 5 to 10 pips above the close of that bullish second tweezer candle. You see it pushes back down, up, down, and then you can hit your profit here. All right, so around this area, sorry, just around here can be your TP. Okay, about 2 times around here can be your TP. The profit would have been hit around that area. So let's look for more. And this time around, this is the breakout price action scenario. Okay, look out for the following patterns immediately after price has successfully broken out from a key zone. It can be support or resistance. Now, the first thing to look at is that usually price makes these moves. When price has broken out from either support or resistance, it has this historical behavior of going to retest. It visits that area. Okay, it visits that area, call it a retest. When price breaks away from a validated support or resistance area, it breaks out from that zone. Usually it will retest. A lot of times it happens. You can see price pushed into this support area, went back up, bounced, okay, and now broke it. You can see it broke it. So when you see that price has closed below that previous support, can be previous resistance, okay, it has broken it. So you will need to wait for price to go back. Price will usually have to go back there to retest, and we call this confluence. You see previous level of support now becoming resistance. Okay, so a retest to that area can give you an opportunity to short the market again. Can give you an opportunity to short the market again. Right, so price established the support here, pushed up, all right, broke it, retested it. So around this area, you can begin to check for some candlesticks patterns, okay, that will support or rather signal a bounce off from the previous level of support, which is resistant at this point, and then you can short the market and get some profit. So the first thing to check when price breaks out from the key area of support or resistance is that it will retest it. So watch out for that, right? So the next thing to look out for is, in taking advantage of a breakout scenario in trading is rising 3. This is what we call rising 3. Rising 3 is actually a bullish continuation pattern that signals that the market will most likely continue to trend higher or lower after breakout from a particular zone. But in this case, this is a rising 3. Okay, it's breakout from a resistance zone. So market did this. This is the configuration, is the pattern that we call the rising 3. Is the pattern. Okay, 1, 2, 3. Now you see this the bull candle approaching the resistance area, and then it drops forming these three short candles. Okay, these three short candles, it forms it, and these three short candles will form within the length of this. Okay, it shouldn't go below. All right, so understand this and identifying this rising three. Okay, so this is the low, this is the low, and this is the high of the first bull candle. And again, this is the high of the second bull candle. Look at this. This bull candle will approach the resistance area, followed by the three short candles before you have another bull candle. These candles will not get to the low of this first bull candle, all right? And then another bullish candle will push up and break this this high, the previous high. You can see it breaks it and closes slightly above it. So this can happen as a retest. It can be a retest. Price has come here, okay, push down to that place and come. So when this happens, it is a confirmation that the market would break the resistance zone. And when you see these three candles, is actually a sign of a continuation in the direction of the underlying trend. You see, it's a sign of continuation. Price approaches there and it gets, and around that area you find this forming is a continuation signal. Okay, it's a continuation signal. So we go to the falling three, just the reverse of the whole thing that happens in the rising three, but this time around it happens at a support zone. When you see this happening around that support zone, it is a very strong signal that that particular support zone will successfully be broken. Okay, another candlestick formation that you can find when the market has broken your key turning point area is the harami, and this is a bullish harami. You have a bullish harami comprised of a very long bull candle followed by a short bear candle. Okay, bull candle followed by a short bear candle. You can find this candle. This is the one that broke that in this case the resistance area. Okay, resistance area, the zone price, this big candle broke it, and then we are seeing a short candle, right? Okay, this actually is a bullish signal. You can see the response that the bears gave to this long one. It means, you know, this trade, the bears and the bulls are like in a tug of war, dragging each other, making it's actually their trading decisions, the decisions that they are trading. Actually, what happened here in principle is that this full move here, some of the buyers had to take some profits, and it caused a drop in volume and price just dropped. Remember, supply and demand. The drop in volume and the price, you know, drops. Okay, is expected because that area has been broken. More of the buyers will come in here because they're looking at, okay, price has slightly dropped. This one is a confirmation of the direction. So at what price am I going to enter the market? That's what everybody's thinking. Okay, let me allow it to drop a little bit. You see them coming into the market at this point to take, you know, the lead, right? So see this happen. The price will push up. Have you traded? And this candle has dropped, can come at this level, okay, about 5 pips above it to put your buy stop. 5 pips, of course. At this time, the turning point, the key turning point area has been broken. All right, and this harami forms. This harami can be what broke it. Okay, price pushing back up in that direction of break should provide you with a trading opportunity. Okay, this is the bullish harami, and here is the bearish harami. The bearish harami is just opposite of the bullish harami, is the bearish signal. Price actually broke the support with this long candle, and then we saw this short bull candle forming, which is the weakness, is a demonstration of failure. okay, of the buyers to take price back to this level. If this candle move back to this level, of course, you know what that means. It's a railway track, which means market is going to reverse. But because they couldn't pull it back to this place because of some weakness, okay, and disinterest in buying more stakes in that particular instrument, okay, what you see is that the sellers, sellers are always interested in price a little bit high. So it's low here. Okay, this is an indication that price will continue to fall, but let me wait for it to push up a little bit before I enter the market. All right, so at the close of this candle, you can see more sellers coming in to the market to form this. All right, so you can see this. How do you trade it? Okay, come at this low of the red candle, right, about 5 pips below the low, to set up your sell stop pending order, the sell stop pending order. All right, at this point, so when the market resumes, the bearish pressure resumes, it will fill you in, and then you are right into the trades. Okay. Now calculating your entries and the risk, so that entry point, take your entries, about 5 pips below or above the signal candles. Okay, I've been mentioning that. And then the risk your position, your stop loss at exactly 5 pips away from the high or the low of the signal candle, as the case may be, whether it's in a buying, whether it's a bullish direction or bearish direction. Then your reward as your take profit point should be about twice your risk or twice the average true range of that particular currency pair. All right. If you got value from these simple strategy video, we'd like you to hit that like button. Hit that like button, subscribe to our channel, and share it to your contacts. Then click on also the bell so that you can be alerted whenever we upload our next video. Thank you for watching this video. I'm going to see you in the next video. Thank you.